Back. So let's get into it. This week we're going to look at some of the analyst forecasts for Silvergate, Signature Bank, and Silicon Valley Bank that have come to pass and aren't looking too pretty in retrospect. Before we get into that, last week's report, not good at all. Interestingly enough, the position that was the least or the most down is now the most up, and I got rid of the Centrus and replaced it with another share of Sprout uranium miners, and I added PACW, which is a bank stock, and I didn't play it intelligently, I would say. I would say playing bank stocks here isn't intelligent in and of itself outside of a value trap, but I guess sometimes you have to speculate, and so I have. Probably playing it with preferreds, because what's going to happen is they're going to raise equity, dilute the shareholders, they're going to cut or probably remove the dividend. They're going to do all kinds of ignorant and stupid things to appease and placate people, even though their balance sheet is well enough. And I wouldn't be surprised. One of the reasons I chose this stock, I should have done a diversified portfolio balance of a few players to hedge out some risk, but maintain upside. But I also probably should have engaged in buying some of the preferred shares for a little extra layer of security while still maintaining a lot of upside. And or, hell, if you think it's not going to go under, then why not buy the bonds? And some of them, trading at 50 cents on the dollar. And so that's a $500 allotment of a $1,000 block. And I don't have that kind of capital, which is one of the reasons why we have this channel, which is incrementally progressing to more and more money and how one can do things. For instance, I still can't, even if I had enough stocks or shares of, say, Transocean, once we get to that point, we can start doing things like selling puts and selling covered calls and so on and so forth. And that's part of the journey that we're on, but we're just not there yet. So I just went ahead, bought 3 shares and moved on with life. And the cool thing is if it goes to zero, which it might, or just get diluted to hell and go nowhere for a decade, is what it is. I don't plan on averaging down or anything else. We'll let it ride, or at some point I'll cut it and take the loss, and is what it is. And one of the prompts for me purchasing that is this chart. And by the way, this is not the same environment as it was in 2020 or 2008, because we're in an inflation regime and we're still in an interest raising cycle. And you could ask yourself, where do you think banks are going to go in the next 6 to 12 months? Let's look at it on that time frame. It's like, okay, well, we have this fiasco. Rates keep going up, and even if they don't, and they start cutting rates, well, why would that happen? Well, we'll probably be in a recession, and at that point, do you think the stock's going to do well? And the answer is no. So either we scalp it for a gain, or we make a trade into a position and hold it indefinitely until we're tired of looking at it. But, so yeah, that's all I have to say on that. So let's get into this. This would be Signature Bank, and the whole point of this is don't take analysts for their word. And sell-side analysts have the point of raising issuance for their companies that are paying them a fee, and to tell you the bull case without telling you the bear case, and to always give you the whataboutisms or the yeah buts and so on and so forth. They're not going to give you a holistic picture. And this would be from March 8th, 2023, Signature Bank. Their call was the crypto landscape for banks just got lonelier with Silvergate winding down operations, while Signature Bank has self-imposed limit on crypto deposits. They may get a bit of pricing power with the exit. We like Signature Bank for its diversification and sub-tangible book value. and their price target was $186. And this is when Signature Bank was at $103. And now Signature Bank is at zero. Well, I can't say it's at $0 because it might go to over-the-counter trading and who knows. But it's not near those prices, let's put it that way. And if they thought it was good buy then, they must think it now. Of course, that's a cynical and sarcastic and snide thing to say because, well, things have changed since March 8th as quickly as one might imagine. Then here we have Piper Sandler's covering Signature Bank on March 12th with an overweight rating. And their price target was $152. And this piece was written at $116. Yet again, nowhere close to that. And I'm not going to cover all the small little details, and hopefully you can read it, which is one reason why I do this format, which isn't the best looking, because it actually helps enlarge the picture, where a lot of times you can actually read the things, because that's one of the things I'm very irritated with financial YouTube, is that they put up all these images and pictures and articles and you can't read the damn things. Then from Wasteland Capital, if you don't follow them on Twitter, you should. This is for SVB Bank, Silicon Valley Bank. On November 15th, 2022, they had a price target of $375. At the time of writing this, it was trading at $219. And as Wasteland Capital outlined, the best part is, while many startups will likely cross having 1 year or less of cash runway ahead over the next few quarters, this will likely serve as the tipping point for startups to accept a lower valuation and raise new funding, which would result in the eventual surge in total client funds. That's part of the bull case. Our business partners are doing so horribly, or our depositors are doing so horribly, that they're going to have to raise more capital to deposit in our bank. So that's the beauty of confirmation bias, is there's always something there to support your thesis. So here's another Silicon Valley Bank, JP Morgan, of March 10th, more recently, 2023, with a price target of $177, much more humble than the, $375. And, or 270 was the prior one of December 23rd. So let's go November 15th, it was $375. Then 6 weeks later, it was $270. And then about 2.5 months later, it was $106. They got it wrong. They got it wrong. They got it wrong. So, on to the next one. Silvergate Capital Corporation. This was price target of $80. Price of writing it was $32 on November 11th. We see the sell-off in Silvergate shares as a dramatic overreaction due to the speculation largely being posted on Twitter around the potential impacts to Silvergate from recent market turmoil. Well, it seems that panned out, and sometimes, people talk about contraindicators and how the market's bearish, so they're going to have a bullish tilt to the market because they're a contrarian. But the fact of the matter is that sometimes the majority of people are just right. And that's another lesson here. So let's move on to other forecast prognosticators and believing people. Here's a comment. There was indeed a broken promise, and we can prove it. Every quarter, the Fed publishes rate forecasts. What did they forecast back in December 2020? Well, their median estimate for 2023's rate was 0.1%, but today it's actually 4.75%, off by 47 times. So any bank who bought long-term bonds on that December 2020 guidance got destroyed. And this individual really is hammering the table about broken promises, because there's a difference between a guaranteed promise and tentative forecasting. And that's a distinction with a difference. And this is a purposeful conflation of categories, because they're well aware that the Fed is dealing with a multifactorial, complex, dynamic, nonlinear system. And to back up what he said, here's a chart, which the link will be in the description. And as he said, 0.1, 0.1, 0.1, 0.1. So yes, that is a true statement. The thing with the Fed funds future curve and projections is that they change. And if inflation is going up, then, which back in 2020, their forecast was accurate given the information they had well enough. And just in recent times, this chart starts January 23rd. So you could say, okay, well, I believe in the wisdom of crowds. And so the Fed's fund future curve and that market is a bunch of very intelligent, highly educated, skin in game participants. And I'm going to pay attention to the wisdom of that crowd. But even they get it wrong, as they've been adjusting higher and higher and higher as time's developed. And the economy, Jerome Powell must be really irritated, because the economy is really staying robust and resilient, and it's really forcing his hand. And I kind of suspect he wishes it was weaker and things would just kind of roll over and we could have a soft landing and move on. But that doesn't seem to be the case at all. And now we have this wrench of a bank that's now causing all kinds of idiocy across markets and other banks. And as of March 8th, I believe it was, when the Fed spoke, they shot up their forecasts for rates. And then no time after, it dropped back down because of the banking situation. So this chart shows you three different lines of what the Fed fund future market thought as of January 2nd, what they thought of, and that's kind of, I don't care so much. They thought it was going to peak out below 5, and then less than 2 months later, they thought it was going to peak out 5.7. That's a, 17% increase, or 20%, however you want to do the math. And the fascinating part is between March 8th and March 10th. March 8th was before the banking situation. March 10th, this is how quickly things adjust and move. So here you are trying to depend upon a quote-unquote promise of what the Fed is trying to project years out in the future, and juxtapose that to how things change within 2 days. So 4 years, 2 days. And back to analysts' forecasts, predictions. Here's Forbes' annual ranking of America's best banks for the 5th straight year. That wasn't too long ago. That was March 6th, 2023. The SVB, Silicon Valley Bank, posted this. Which means Forbes somehow figured out, not quite sure how, that Silicon Valley Bank was one of the best banks. And I'm not sure if that's the propaganda and the ESG and all that other stuff that they're doing, or how they calculated it. And wasn't best balance sheet. So with that said, this was a quicker video, and thought I'd share it with you, put things a little bit in perspective. Thank you for watching, and maybe the portfolio will do a little bit better by next Friday. Thank you for watching.